Erin Kennedy here today with Evan Niu. We're doing Tech Teardown for Friday, April 11th. News broke this week that Apple may be considering a significant overhaul of its iTunes store. The move would be a response to declining download sales as streaming models are gaining popularity. What's going on here?
So Billboard reports that iTunes Radio hasn't been a big success so far as the record labels are concerned. Only about 1 or 2% of listeners are actually using the referral links to buy those songs on iTunes. At the same time, downloads overall are declining about 15% each year. And also, iTunes Match, which is Apple's first attempt at streaming your library over the cloud, only reportedly has about 1 million subscribers, which is from their sources, because Apple has never actually disclosed an official number here. This is all kind of part of this bigger picture. So the response might be from Apple that they need to kind of really revamp iTunes to really very much more aggressively embrace the streaming model. At the same time, there's also been talk that they might actually open up their iTunes Music Store to Android, which would be kind of similar to how when they opened iTunes to Windows a decade ago or whatever. But it's important to note that this report is really judging iTunes Radio from the music label's perspective.
Well, it seems like each quarter Apple announces record quarter billings for iTunes, but if there's growth there, if it's not coming from music, where's it coming from?
So you're absolutely right. Every quarter they do talk about how this number is growing. So last quarter, for example, they said iTunes billings were 4.7 billion, which translated into recognized revenue about 2.4 billion, both of which were all-time records for them. But they primarily attributed this to an increase in App Store sales, not music downloads. But if I'm Apple, I'm actually happy about that because I'd rather have people buying apps as opposed to music anyways.
Well, so iTunes Radio, let's be realistic. It's not a meaningful part of Apple's bottom line.
That's not why you bought your iPhone?
Yeah, it's not driving, device growth. So, why should investors care about iTunes Radio?
So you might remember that Apple said that, back last year, they said they had about 20 million users that are already on iTunes Radio after about a month after launching the service, which is a pretty decent number. About a month ago, they also ranked, in a third-party report, the third most popular streaming service behind Pandora and iHeartRadio. But I think, like you said, iTunes Radio isn't this big device sale driver, but I think it's kind of like when you look at any of the content providers. So it's kind of like the record labels are analogous to app developers, who they're third-party entities and stakeholders that are providing a big, important complementary content source that helps grow your ecosystem. So they do want to have their partners succeed. So they want the record labels to do well, but ultimately their interest is each one wants to sell their own stuff, right? Apple wants to sell the phones or iPads, and the record labels want to sell the songs. So I think they're very similar in that sense. But Apple might also be losing a little bit of its sway with the labels because now they're contributing less as a total percentage of the the industry's revenue, whereas companies like Pandora and stuff are actually starting to generate more revenue for the labels. But this day and age, I think the important thing is that apps are much more important as far as this platform stickiness goes, because apps will never be crossed by iOS apps will never go to Android.
They won't be ported.
They'll play. Developers might make them for both, but you can't bring your apps over from across. Whereas music you can. So in my sense, right now, if the goal is to keep make this platform sticky, apps do that a much better job of that
than music
does. So in that sense, I think the risk here is much less to Apple, and especially another thing on the app front is that you look at the pool of content creators in apps, it's enormous. There's so many developers out there that can make apps, which means that the risk is more diversified, in how many people you have to make happy. Whereas in the music industry, it's just a handful of these big labels that you have to kind of satiate and make them happy. So I think it's overall actually, not a bad thing for Apple.
Nike probably doesn't fit your description of the average tech company, but the apparel maker has been a pioneer in wearable fitness tracking devices with its popular FuelBand. However, it seems Nike might be bailing on that gadget. What's going on here?
So FuelBand is one of the most popular wearable fitness device trackers at the moment. I think its success was kind of a probably pleasant surprise for Nike, but at the same time, they have never disclosed official sales figures, which also hints that it hasn't been too meaningful. Third-party estimates from NPD estimate that the total fitness tracking device market was about $330 million last year, and Nike grabbed 10% of that. So we're talking $33 million in revenue estimated. Nike's
That's
total,
not a lot to Nike.
Their total top line last year was $27 billion. So this isn't a huge thing for them. So it's not like hardware has become this actual meaningful business, even though they are getting some nice success. But I think that Nike has now built this data fitness platform with Nike Plus, and the hardware side is just it's about to get really intense competitively. We got all the bigger actual tech names that are going to be much more specialized in wearable hardware are about to jump in. I mean, Google announced Android Wear with all its hardware partners. Right. Everyone's expecting.
Galaxy Gear, probably going to be an iWatch.
Yeah, I mean, like, it's about to get pretty crazy. So I think, it makes some sense to
Makes some sense to bail. Well, so Apple CEO Tim Cook has sat on Nike's board of directors for years, and he also has talked about how he likes his FuelBand. Do you see some kind of possible partnership here? Is the iWatch going to have, will it be co-branded with Nike?
There might be something, because that's also part of this report, is that there's this rumor that instead Nike might ditch the hardware, but they can still partner with someone like Apple because there's obvious connection through Tim Cook. And the FuelBand app has always been exclusive to iOS, so that's always been an advantage that Apple has enjoyed from kind of mutually beneficial partnership there. Mm-hmm. And everyone expects the iWatch to come out this year, and everyone's also expecting Apple to really focus very heavily on this fitness and the wearable data aspect of. That's what their main push is probably going to be with HealthBook, and we've seen all these rumors about HealthBook.
Right.
But the thing there is that Apple doesn't have a lot of experience or user data around fitness activity, whereas Nike does. So I think that if Nike wants to get rid of hardware because it might end up being a distraction, Apple wants to get tap into this platform or existing data. I think it's kind of a win-win situation for both of them if this actually turns out happening.
The latest numbers on the global PC market are out. As expected, shipments continue to fall, but actually came out a little better than anticipated. What did IDC report?
So IDC said that about 73.4 million units were shipped in the first quarter, down 4.4%. They're expecting the drop to go over 5%, so it's actually a little bit better than expected. U.S. is stabilizing with around flattish growth, about 14 million units. Asia Pacific, excluding Japan, was actually very, very weak, dropping double digits, but EMEA and Japan were actually very strong. Lenovo overtook HP as the top PC vendor in the world a couple years ago, and they're just kind of extending their lead right now.
So what's driving this better than expected performance? Everyone talks about, the dying PC market. What's this little comeback about?
So a big part of what's happening right now has been, or last quarter, was the pending end of support for Windows XP, which happened this week. Mm-hmm. That's kind of driven this really large upgrade cycle within the enterprise and corporate markets to kind of get off this, XP, because when with Microsoft dropping support, opens it up for a lot of security vulnerabilities going forward. So it's pretty important to kind of go ahead and upgrade. Japan's enterprise refresh was also very strong. It's kind of a side note of what happened in Japan is they also had a value-added tax increase that was going into effect in April. So everyone knew this was coming. I think the sales tax is going from like 5 to 8%.
So people made large purchases.
So everyone was jumping, wants to get, if they're making a big purchase, they want to do it before this takes effect. Right. That's certainly a temporary little jump there, but another thing that's kind of also driving up the Japan purchases. Within the U.S., Windows OEMs saw pretty big jumps, specifically Dell and Lenovo, who are big enterprise PC suppliers. And Apple gave up a little bit of its share domestically. But we'll have to wait and see, as far as Apple's concerned, when they report how they did on a global perspective. But a lot of it's coming from Windows XP.
Well, so you mentioned Windows XP, and you also mentioned the special tax thing in Japan. Those are temporary things. Like this little resurgence, is that also going to be temporary? Is the demise still happening? Is the PC still dying?
I think that the PC will still is probably going to flatten out around this 300 million units per year level. It might be a little bit negative this year, but I think it'll probably end up flattening around there. Tablets are still continuing to cannibalize PCs to an extent, but it's still going to take a long time for that to all play out. Microsoft has another Windows update coming up soon, but that's not as meaningful. I mean, they're backtracking a lot of their interface stuff that just didn't go over very well, but that's not going to be like a growth catalyst in a meaningful way like this one is. And I mean, the important thing here is that major enterprise upgrade cycles of this magnitude don't come along very often. So I think that once this, we get through this one, it's probably going to flatten out a little bit.
The smartphone processor market has exploded in recent years alongside global adoption of smartphones. However, this market isn't stopping anytime soon, and it's actually expected to continue soaring over the next few years. What's the news here? So
Strategy Analytics has released some new estimates saying that they expect smartphone processor market to grow by about 11% annually until 2018, going to hit this about $30 billion market size. The big drivers here will be LTE Advanced, which uses carrier aggregation to really substantially boost cellular data speeds, in addition to this widespread transition within the industry to 64-bit architectures that Apple kicked off last year. Within the market, and we've touched on this before, that there's this big shift from standalone processors to ones with integrated cellular models, and that's going to continue happening. Penetration is supposed to increase even further. Big winners there would be Qualcomm, MediaTek, Broadcom as kind of the rivals catch up and start building their integrated things. Multi-core penetration is also going to increase. So a bunch of different factors that are going to really kind of drive this market higher.
You mentioned the 64-bit chips. There's been a lot of hype around them. A lot of it due to Apple hyping it, obviously. But it seems
Fastest chip they've ever made.
it seems like that transition isn't gonna happen real fast.
Yeah, I mean, this is a much more complex transition because it's an architectural thing, but it also, when you're talking about this level of transition, there's a lot of software compatibility issues that you have to also address, and that involves getting your entire army of developers to optimize their apps around this new architecture to actually take advantage of all the gains and performance improvements. So in 2013, Apple was the only player shipping a 64-bit smartphone chip, and the penetration is only about 3% of the market. That's expected to go up to 75% by 2018. And Apple, Qualcomm, Samsung, and Intel are expected to be kind of the big drivers here.
You just said Intel, and I don't really think Intel when I think smartphone chips. What's going on there?
Most people don't, but and you're right. I mean, they don't really have very much share in smartphones right now, but they're really trying and trying probably harder now than they've ever had before. But I think that the idea is that they might be able to gain upwards of 20% market share by 2018.
Is that really meaningful to a company as big as Intel, though?
It could, because remember we were just talking about PCs. I mean, PCs are still kind of like just stagnating.
Right.
I mean, that's been an ongoing story for years, and this will be a high. The prices will be much lower than what they used to enjoy on PCs, but they can make up for in unit volumes, because I mean the smartphone market is now total at about 1 billion units. If PCs are at 300 million, you can make up for it in dollar terms, even if maybe the margin percentage isn't as nice as they used to enjoy on PCs. But I mean, they still have their leads in manufacturing technology, and they're expected to launch integrated integrated 3G and 4G cellular chips pretty soon too. So they might actually be able to gain some traction against these whole ARM-based competitors.
There's a bit of confusion this week over the fate of BlackBerry's phone business. It all started with a Reuters interview. What did CEO John Chen say?
So the quote that kind of sparked all of this was, in this interview, Chen is quoted as saying, "If I cannot make money on handsets, I will not be in the handset business." Right?
Well, that seems pretty reasonable, right?
Sounds fair.
Sounds like a good business plan to me.
But then this soundbite kind of like snowballed in all these headlines that BlackBerry is considering exiting the phone business, and it prompted Chen to actually do a blog post directly, and where he said the quote was taken out of context. BlackBerry remains committed to handsets and just needs to make them profitably. He notes that BlackBerry is an end-to-end solution company, so they want to own the whole thing, and that includes devices.
Well, so I have a question of taken out of context. I mean, what was the context around it? Like that just seems like an easy little way to be like, just kidding.
It was funny because Crackberry kind of downplayed the storyline, and then Reuters responded to them directly saying, "Hey, he said this. There were 20 people here. He said it." I mean, they didn't provide the whole interview or anything, but they're very much standing behind this quote that he did say it. So, yeah, I mean, there's probably some truth to both angles, though. I mean, like, a lot of BlackBerry's user base is very loyal, diehard, and they love their hardware keyboards. And I say a portion because we also know a lot of people are switching out. There's this T-Mobile promotion that they got a lot of uptake from people switching to other platforms, which is a whole other media debacle.
So do you think John Chen backtracked because he doesn't want to alienate the loyal Crackberry fans?
I think that's part of it, because I mean, you don't want to make if you're a smartphone buyer and you think this company is about to stop making these smartphones, you're not going to buy it because you're not going to have ongoing support for this device you're about to buy. So they want to keep confidence among their current users, but at the same time, I mean, Chen is basically in this really precarious position that he has to balance his consumer interests with his investor interests, because yeah, I mean, you have to eventually make money, because if you're focusing too much on the consumers and by losing money, that's not good for your investors. So I mean, it's the key is that he has to do this profitably.
Right. Well, the thing is, though, is BlackBerry has been losing money on hardware, like buckets of money on hardware, for literally like years.
Years, yeah.
Yeah. So I mean, I think there was a lot of truth in what John Chen said, and I'm not really sure. Do you think they have a hope to actually make phone's profitable.
So, yeah, I mean, like you said, software and services have been generating pretty much all of their operating income for the past couple of years while they've been losing money through operations in handsets. But it's really hard to turn around a hardware business like this. But that being said, I do think they're making progress. They're doing a lot of cost cutting, plus this new partnership with Foxconn where they outsource some of these supply chain functions, reduce inventory risk. Those are all steps in the right direction. But, I mean, again, this is a really hard thing to actually do, and they're trying really hard, and they're making some progress. But ultimately, at the end of the day, it remains to be seen if they can actually make these things properly in 3, 5, 10 years. And if you can't, you don't really have a choice but to exit the business.
Right.
I mean, like, you have to eventually. So, again, I think it's just, he's right in the middle. It's like he doesn't want to, but he might have to eventually.
So what do you think Blackberry investors are thinking right now?
They probably want to know what's going on. They probably want some visibility. Like, I mean, I'd be kind of worried if I was getting these kind of mixed messages. So I don't know what's going to happen. I mean, again, we'll have to wait and see. But I mean, I think they're making progress, but the odds are against them.
All right. That's all for today on Tech Teardown. For Evan Niu, I'm Erin Kennedy, and we'll see you next time.